In this video, I'm going to talk about the efficient market efficiency and the efficient market hypothesis. So let's talk a little bit about the efficient market hypothesis. The efficient market hypothesis basically indicates that stocks are priced correctly based on the information that is available. And so therefore, there aren't any bargains or anything like that. And so basically by being efficient, it means that the prices that are observed are reflecting the information that's available. Now, there are a few different levels of the efficient market hypothesis. So let's kind of walk through those. The first form or level is the weak form efficiency. And at this level, this indicates that market prices reflect all prior stock price and volume information. So here's what that means. If I pull up a stock chart that shows how stock prices have changed for a stock over time, or perhaps it shows volume information, it shows how the volume of trading that's gone on. Basically, no amount of looking at those items will enable me to figure out which stocks are going to do better compared to others going forward. And basically what this means is technical analysis, which is basically an analysis looking at various measures and metrics associated with price patterns and volume movements and things like that, is not going to help me find bargains and stocks to invest in that look attractive. And the logic behind that is it's just too easy to find that information. So if there's anything we could have learned from looking at stock prices or volume information, we would have already learned it, and the stock price would have already responded as a result. So if people could have concluded something, they would have then bought the stock, but that would have made the stock price go up, which then would have meant that that mispricing that people thought they had determined is no longer there. So let's take this a step further. We get to the semi-strong form efficiency. Semi-strong form efficiency basically says that market prices reflect all publicly available information. So what this means is that basically not just stock price information, not just volume information, but any kind of publicly available information, stock price is reflected. And as an example of this, if you've ever looked at how quickly the market responds when there's news that comes out. So if there's news about a new inflation report, new jobs or unemployment report, or perhaps information about some kind of global event that's going on, or some kind of company-specific event like a lawsuit or a new product launch. Basically, what we can observe is that stock prices tend to respond quite rapidly to that. And so semi-strong form efficiency is saying basically that market prices are going to reflect all publicly available information. So if there's some kind of publicly available information that's out there, basically the stock prices are going to reflect that. Strong form efficiency basically takes that a step further, and it says that market prices are going to reflect all public and private information. So basically what that would mean is if there is information such as the email that's gone to the CEO of Apple, and basically if that email has arrived at a particular point in time, and he's seen it, even though it's not publicly known, that basically that information is going to be incorporated in the stock price. And you might look at that and think, well, that's kind of a bit of a harder sell. How exactly would that actually have been incorporated? How exactly would that have been something that would wind up factored into the stock price? And the reality is that there's a real question there of, is that actually going to be factored into the stock price? But there's also a logic for how it could possibly be factored in. And the way that it could possibly be factored in is we may not know what the CEO of Apple has in his email, but I can watch what he does. So I can look at whether he's talking in a more optimistic or pessimistic manner. I can look at the kinds of things he's announcing, whether he's saying that products are going to be might be delayed. We may not know that there was some kind of a problem with a product development or something like that, but I can watch what the CEO does, and that gives me an idea about whether or not he's seeing something positive or negative. So there is sort of a mechanism by which some of that private information can kind of leak into the stock price and be reflected in the current stock price, even though it's actually not publicly known. But generally speaking, most of the studies that have been done of market efficiency have landed on the idea that the market is probably pretty much semi-strong efficient for the most part. And basically what that means is that stock prices reflect all publicly available information. And they seem to do that pretty fast overall. Now, some implications. If the market is efficient, then that would mean that all those stocks are correctly priced. So that, in other words, the market price and the value of the stock is basically the same, or it's at least sufficiently correctly priced that investors can't take advantage from any kind of mispricing. And what that would mean then is if this is the situation that I'm in, if I want to invest, basically what we're going to do is we're going to determine the level of systematic risk exposure that we desire. We're going to diversify broadly while maintaining that desired level of systematic risk. And then we're going to hold for a long time while periodically rebalancing. So basically what we're going to do is we're going to decide essentially how much risk we want to take on in effect. And once we've decided kind of how much risk we want to take on, then we construct a diversified portfolio that has that level of risk. And then what we're going to do is we're going to hold on for a long time with that target portfolio and just periodically rebalance, which basically just means we readjust our portfolio to kind of stay at the ideal level that we want to stay at. So pretty much not a lot of active kind of work here. We're going to be pretty passive investors. We just come up with our target portfolio and basically just kind of stay the course. Pretty much that's the idea. On the other hand, if the market is inefficient, meaning that stock prices do not correctly reflect all the information, then that opens up the possibility that there could be some stocks that are actually worth a lot more than the current market price. Could also be some stocks that are worth a lot less than the current market price. So if that's the case, if the market is inefficient, then what we want to do is we would want to invest in the undervalued securities. And those would be the securities that are, say, worth $50, selling for 30, right? So if it's worth 50 but selling for 30, if I buy something that's worth 50 for $30, something good might happen to my investment portfolio, right? So we're going to try to find those companies. We're going to try to invest in those. We might even short sell overvalued securities. Short selling is kind of interesting. Short selling is basically when I borrow the shares from somebody else, I sell them in the market, and then I hope to buy it back later when the price is lower and then return it to the person I borrowed the shares from. So ultimately, we're still trying to buy at a low price and sell at a high price, but I do it in reverse order by borrowing somebody's shares to make it possible for me to sell before I've actually bought. So basically with short selling, what you're hoping is that the stock price actually goes down. So if I think that things are undervalued, I would want to buy it and hope the price goes up to match the value. If things are overvalued, meaning in this case, maybe a stock is selling for $100, but it's only worth, say, 75. In that case, I would expect the price to drop to match its value at some point. And so that's when I might short sell those possibly. So this would involve a lot more active analysis, a lot more engagement with the market and trying to find the things that are great deals, avoid the things that are bad deals, maybe even short sell them, and so forth. Now, there is kind of an inherent connection here with behavioral finance. So economists and finance researchers have done a lot of research trying to figure out to what extent is the market efficient or not. And basically, one of the things that's significant to note is market efficiency is linked to the idea that investors would make rational choices. We don't necessarily have to have every investor making rational choices, but generally, the more rationally investors are behaving, the more you would tend to expect that the market efficiency would hold. So with behavioral finance, this is looking at kind of some behavioral biases and ways that people actually interpret information and act on information in ways that aren't necessarily, wouldn't be considered to be economically rational necessarily. So for instance, to use a slightly different example, they actually have done some studies where if you presented a group of people with, let's say they were told to assume that they had a disease, and then they were presented with a couple of treatment options. And if the treatment options were presented in terms of survival rates, in other words, what proportion of people survived after a certain number of years, people tended to choose one particular option. On the other hand, if let's say a treatment involves 60% of people surviving, well, if 60% of people survive, that means 40% of the people did not. Well, they took that same information, presented it to a group of people with, all right, imagine you've got this disease, this treatment that's available, here's the percentage of people that die. So it's the same information, but just expressed differently, right? And from an economic standpoint and sort of a rational analysis standpoint, theoretically, people should choose the same options because it's the same information. If I tell you 60% of the people survive, or I tell you 40% of the people die, I mean, with this treatment, it's the same information, right? Well, what they found was basically people actually made different choices. right? And so similarly, if you present investments as, if I tell you, here's how much you might gain, or here's how much you might lose, investors might actually make different choices. Or they may be willing to take risks in some scenarios, but they'd be risk averse in others. And one example for that is investors tend to act like they like risk if it involves avoiding losses, whereas they tend to act like they dislike risk if the situation they're facing involves the potential for gains. So some interesting scenarios there, basically. And because of that, there's a possibility that people don't actually rationally assess things, and they are making some choices that are perhaps not economically supported. And that means that maybe, possibly, some investments aren't quite priced correctly, perhaps, because of the possibility that people are making irrational choices. So there's some interesting research that's been done in that area that kind of looks at that and tries to figure out to what extent does that affect investor choices and so forth. Generally speaking, most of the studies have landed on the idea that it looks like probably the prices tend to be, on average, relatively semi-strong form efficient. However, there are still some questions about that, and maybe there's some exceptions to that. And so there are some researchers that think, well, maybe it's not all that efficient. Kind of depends on the circumstance, perhaps. All right. Hopefully this little discussion about market efficiency has been helpful. Thank you so much for watching, and have a great day.